Hello, everybody, and welcome to the Trading with Ashley show. I hope you're having a wonderful weekend and you're starting to prepare for this week's worth of trading. I wanted to give you a little bit of an overall general concept on what I'm looking at this week, what you should watch out for. We're going to go over the Fear and Greed Index and how things are looking for that. We're going to look at the overall markets in general so I can tell you when I might strike again a little bit heavier on one of my favorite plays. And I'm also going to hit the highlights on what is happening on the economic calendar this week. It's not a lot, but there are a few things that could be market moving. And also, finally, I am going to give you a play of the week. This one has to do with Meta. Now, I have been working with a lot of you on different trade setups, and I like to strike when it looks like technically it's at a really good point to do a trade. Amazon is the trade that I had been most focused on, and that one is starting to work out really well. I'm waiting for it to do its recovery. Meta looks like it may be next with a potential opportunity. So be sure you stay to the end so that you can see that particular trade setup and how I might be playing it. All right, let's go jump into the computer so I can get you ready for this week. First, I want to take a look at the Fear and Greed Index. Right now, we are in neutral, which actually is helpful in my perspective. I really don't get worried until we are in extreme greed. This is when I start doing a heavy cash allocation. When I'm in extreme greed, I like to be at least 30% cash at that point, because we more than likely will pull back at that point, and then I'll have that cash ready to deploy on something else. I start paying a lot closer attention when we're in greed. Now, we just slipped from greed to neutral. That's showing that the market is just really waiting for the next direction on the market. If we slip down to fear or even extreme fear, this is when I do my heavier buying. So right now, I'm really taking conservative trades. I'm leapfrogging over October, which is the potential volatile month, and I am usually taking my trades a little bit further out so I'm insulated against direct pull downs. Not taking quite as many trades right now since the market has been at all-time highs, but I am still trading. There's always a trade in the market. It just depends on what the stock is and where it is in its price life cycle. So we're in neutral right now, not a horrible place to be. It's just everyone's right now optimistically cautious. The next thing I like to do is I like to take a look at the technicals on the NASDAQ. Now, typically, I'll use the 3-month chart. The reason I like looking at the technicals on the NASDAQ so much is a lot of the stocks I trade and that I sell options on, they are traded in the NASDAQ. So let's take a look at that now. You can see we're at 63 on the RSI. So at some point we had been closer to 70, showing that we were overbought at that point. Now we're kind of hanging out in the upper quadrant of the Bollinger Band. So any pullbacks to 586, which is the 20-day moving average, I will start to deploy more capital behind trades in the queues. And then if we get down here to this 50-day moving average, that's when I will finish out any large buying that I plan on doing for 2025. Now, why am I not waiting till we get down to the 200-day moving average? Well, we've already been there and below there. That's when I deployed most of my capital this year, and now I'm reaping those rewards. So pullbacks will happen. I just don't think we're going to have aggressive pullbacks for the remaining part of the year. Why is that? Well, mainly because the institutions missed out on so much of the buying that anytime we pull back to these moving averages, here the 20 and here the 50, they start actually buying back in. So that insulates us a little from deep correction, or at least staying down for long periods of time like we did at the beginning of the year. Next, let's take a quick look at what's happening this week on the economic calendar, and then I'm going to go over a potential trade for you with Meta. So the first thing that we have to look forward to this week is ISM Manufacturing. ISM's diffusion index from supply managers on orders, production, employment, and deliveries. It's expected to come in at about 48.5. Why does it matter? Well, a surprise above 50 could rally stocks in the industrial sector. Then the other thing we have to look forward to this week is non-farm payrolls report. It's on Friday, October the 3rd, before the market open. What is it? It's the flagship monthly job snapshot. It covers non-farm payroll additions, unemployment rate, wage growth, and participation. September forecasts have it at around 150,000 jobs added, 4.2% unemployment, up 0.3% monthly wage growth. Why does this matter? Well, post-Fed rate cuts, this gauges labor resilience in cooling inflation. Strong data could delay further cuts, spiking yields and pressuring growth stocks. Weakness, on the other hand, it might stroke recession bets. Finally, let's take a look at Meta, ticker symbol META. When I first look at a stock, I like to look at the PE ratio. Meta is at 26.96, very respectable. Now let's look at the analysis chart. Everything is looking good and healthy on the analysis chart. Our revenue versus earnings is intact. We have outperformed on earnings. That's strong. And then our price targets, well, they're above where we are now. So that's encouraging. Let's look at where we are on a chart. Looking at the 3-month chart, this is starting to look really interesting. Let's look first at the RSI. It's the first thing I look at when I'm evaluating the technicals on a stock. It's at 43. Anything under 50, it shows there is more selling pressure, which could push this down a little bit further to important moving averages. So let's take a look at that. We just slipped below an important moving average. It's the 50-day moving average. So where are we headed next? Well, it looks like right here at the bottom of the band might be a really good pickup on this stock. You notice the candle right here. It's got a little bit of support right there. The bottom of the band sits right at about 728. Right below that, right here, this blue line, that's the 100-day moving average. It's another important level for a stock. So the trades that I will be looking at, if I'm selling a put, I'd want to shoot for the bottom of the band. But if I'm going to do a credit spread, I'd want to go below this 100-day moving average. And then if I want to be extra safe, I'd actually look below this 200-day moving average for a credit spread, which you could do that if you go further out and still get decent premium. Let's go take a look at potential trade setups. For my first trade, which is a sold put, I'm going to go out to 11.21. Now, this will take a lot of capital because this is a higher price stock. So this would be for my larger account holders if they're interested in this trade and if they don't have enough exposure to Meta. One thing you can look at is right here around that 730 mark. Now, notice the delta is aggressive right here. But remember, deltas are only telling you based on the current price action, the likelihood of settling here action, which we have Meta at a low point right now. So this allows me to be a little bit more aggressive on my sold puts. I would not mind picking up Meta in November at the $730 mark because look, I am getting such significant premium. This is $33 a share. So I am going to get $3,348 to agree to buy Meta at $730 a share. So effectively, this is putting Meta below $700 for me, which isn't a bad option for me looking at November. Now, if I'm going to do a credit spread, I want to go down even further, and I will more than likely go to December because this will allow me to go down further and still get decent premium. If I'm going to do that, I definitely want to look somewhere closer to here, which is around the 665 mark for that 200-day moving average, just to be safe. To start this trade-off, I'm going to look right here. Do you notice on 665, that's a 0.2 delta, and it is paying $17.85 if I were to sell a put, but I'm doing a credit spread. So I can still get really good premium for my starting trade. So for safety, I am going to go well below that 200-day moving average. I am going to go ahead and start my trade right here at 640. It's paying $12.73. So this will be my sold put. For my purchased put, I am going to go ahead and make this a $20 wide spread. So I'm going to go down to 620. I am going to buy that put. When you send it to a ticket, you can get a better sense for how much it will cost to put this trade on and how much premium you will receive. So here it is right here. It would require $2,000 to put the trade on, and I will receive $300 in premium. Now, the reason that you only see $1,700 here is it's taking into account that you're getting $300 in premium to put this trade on. So this is a decent risk to reward setup. Now, how would I manage this trade? Well, after I go ahead and execute the trade, I will more than likely decide to exit once this $3 that I received whittles down to about $1.50. That's about a 50% profit. And if Meta hits one of those important lines in the sand that I showed you and then heads back up, more than likely that will take place within the next couple of weeks, maybe the next month even. Now, when would I exit this trade if it's working against me? Well, this is so far below the 200-day moving average, I wouldn't do anything unless I saw that it pierced through that 200-day moving average and then was heading for my strike price after about 2 or 3 days worth of action. If it stays under that 200-day, then it would be more than likely heading to my strike. So at that point, I would bail on this trade and call it a loss. But again, I am expecting a bounce on the 200-day if we get that low, so I will not decide to take action until I see it stay below the 200-day, at least for 2 or 3 days worth of action. Now, just a couple of updates on some things that you have been asking about, I've been seeing emails for. When it comes to my options bootcamp, that is going fast. There is literally only a few spots left. So if you're interested in that, you want to go ahead and sign up for a brief call where we can explain it all to you and you can join if you're interested. I do not do these often throughout the year. So once this time is over, it might be a while before we go again. Now, for those of you that are interested in my new trader network, it's for smaller accounts where I teach you how to scale an account. We are currently in week 2 of a 6-week challenge on credit spreads. We're doing extremely well. They've already made their money back for a couple of months in the program. So if you're interested in joining us for the last 4 weeks of the credit spread challenge, there's a direct link below for you to join. Now, that's a monthly subscription. You can cancel at any time. If you're interested in that, click that first link below under New Trader Network. Remember, if you're with me, Trading with Ashley, there is no trader left behind. Now, I picked out the perfect video for those of you that are interested in learning a little bit more about selling options before we get going tomorrow. You can watch that video right here.